Hey everybody, it's John King. It is Friday the 4th of April. Man, has it been a wild week. We started out the week Tuesday being April Fool's Day, and it seems like every day since then has been Groundhog Day, a repeat of new April Fool's jokes every single day when it comes to the economy and the markets and where things are going. It has been craziness, and we expect the craziness to continue. So where are we at? First of all, the number one thing, Trump's tariffs return on Wednesday. I think he called it Liberation Day. I don't know. We're going to see. I'm talking and listening to people that have mixed emotions across the board on not just emotional. I'm talking about tactical, logical reactions that range from, look, Trump's actually accomplishing the goal he had. Trump came into office saying, I'm going to lower interest rates. And everybody said, no way, you can't lower interest rates. The federal government's not in charge of rates. The federal government is not in charge of the Federal Reserve. Trump, you're on crack. You can't lower interest rates. That's the perspective. Now, some really smart people are saying, actually, he's doing a great job of lowering interest rates because he's basically driving the economy right now towards a recession. Now, you can argue that that's like saying, hey, I'm gonna get a brand new car because I'm gonna crash my car into a ditch. Well, yeah, I guess you're gonna get a brand new car, but you might die in the process because you crashed your car in the ditch. Again, I'm being neutral. I don't want to paint either side as being better or worse. We're only going to see where it goes by watching it play out. But the fact of the matter is that there are some people thinking that Trump is actually playing a very smart hand of poker here. And so I want to explain kind of what side, how that looks and how that goes. Basically, we already saw it this afternoon. I'm recording this Friday afternoon at 1:15 Pacific time. And we saw that earlier, Vietnam had said, hey, we're willing to make some concessions. And Trump's administration says, cool, then we might be willing to drop your tariffs. And so there's an argument that everybody said for the last few months about, hey, tariffs are about him trying to negotiate. Well, the problem is that if you bluff too much, the other side thinks you're never going to actually execute, that you're never actually going to do anything. And so he called everybody's bluff, or they called his bluff, and boom, here we are with a bunch of tariffs, and they're really, really significant, and it freaked out the market, And so we've seen the Dow Jones Industrial Average drop significantly. There was just literally, as I was about to come on here, I saw a pop-up from the Wall Street Journal. Breaking news, a 2,200 point drop in the Dow ends a brutal week for stocks. More than $6 trillion has left the market, has basically been the amount of value that has vanished from the market in 2 days. Now, I have other people that I'm listening to that are saying Trump has no idea what he's doing. And there's argument can be made on the other side saying he's simply a megalomaniac who is trying to create his own agenda and he's out of touch with reality. He's focused on protectionism and focused on how do we make the United States the superpower that it was 50 years ago of producing everything in its own borders and having all these factories up and running. I mean, that's an argument that, A, if he achieves it, that might be good for the United States long term. It might not, because there's an argument that you're better off getting goods and services from other countries that are better producing them at a lower cost and focus our energy and effort on the things we're good at producing at a lower cost. I don't know what the right answer is. What I know is that turmoil is here. And we've seen a huge amount of turmoil. So let me explain the correlation of what's happened over the last 2 days. We have had a significant drop in the 10-year Treasury, like really, really significant. I'm actually going to pull up a chart right now to show you just how significant I'm talking about. I'm talking like really significant. All right, so let's go here and here. All right. So what you're seeing right here is you're seeing a chart of the 10-year Treasury. Now, this is, how far back is this going? This is just today. All right. So today, it doesn't look like that big of a deal. Hey, John, it's down, and then it's right back up. Well, yeah, that's because we're zoomed way in. So let's zoom out just a smidge. So this goes back to Wednesday. But let's go back a smidge further. This goes back to March 27th. Let's go back a smidge further. This takes us back to February 19th. So we've seen drops and we've seen drops and we've seen drops. And then we had the biggest drop. So basically starting here 2 days ago, On Wednesday, we were right around 4.2% on the 10-year Treasury. It fell to 4.1 yesterday, and now today it opened this morning at 3.9%. We have not seen 10-year Treasury down at where it is right now since October of 2024. And we were lower than this previously. We were down here in the sub 3.6% range. There's an argument we could go back there. And we just saw it pop right back up. We just saw it come back up late in the day today. So what is really happening is the 10-year Treasury is going down because that's where money goes when people pull money out of the stock market. And so we've got money coming out of the stock market and they say, what do I do with this money? I need it to be safe. And so they put it into 10-year Treasuries. 10-year Treasuries are a bond, a debt issued by the federal government that is guaranteed to be paid back by the federal government. It's considered to be the safest investment out there. Mortgages are another bond. They're just not debts issued by the government. They're issued essentially by homeowners. And the investors that are investing in these are saying, hey, I am willing to take an investment into homes instead of into the federal government, but I have to get a bigger rate of return. I want to make more money. Okay, it's risk versus reward. Investing in individual people is a higher risk than investing in the federal government. Therefore, there's a spread. Well, what's happened right now is that the 10-year Treasuries dropped significantly, but mortgage rates really have not yet. And there's lots of reasons why. Okay, so I'm going to give you a few reasons why mortgage rates have not fallen anywhere near as much as what we would hope or expect, given how much the 10-year Treasury has gone. First of all, rates go down slower than they go up because the mortgage industry is predicting where the rate is actually going to be in 30 or 45 days when we fund your loan. We're locking it today with the expectation of where rates are going to be. And so we are not actually freezing buying your rate on the market. We're not selling your loan to Wall Street today. We're selling your loan to Wall Street in 30, 45, 60 days once you get your keys. And so we are hedging. We are guessing at where the rates are going to be in 30 days based on what we're seeing today. And we're going to take a cautious approach. When it sounds too good to be true and rates have dropped too really, really quickly, we want to make sure that's actually going to play out and not just a short-term volatility. Yesterday morning, we had something I haven't seen since 2020. Yesterday morning, we had Cal HFA unable to provide interest rates because the market was too volatile, because that was when the market opened after Trump announced his trade tariffs on Wednesday, and the Dow fell significantly, and it was impossible to predict even that morning where rates should start out for that day. So a lot of volatility, but what we're going to see is we're going to see mortgage rates start coming down as long as the 10-year Treasury stays low. But here's the challenge. The challenge is some investors are saying, wait a second, the 10-year Treasury is dropping because there's a real good chance that our presidential administration is going to drive our economy into a ditch. It's going to send us into recession. And if we get into a recession, more people are going to be unemployed. And if more people are unemployed, then we're going to have more people unable to pay their mortgage. Why do I want to invest in mortgages when mortgages may become a problem in the coming cycle? Now, the truth is, I don't think that's going to happen. I think, by the way, I think all of that could happen. I don't think mortgages are going to be a problem big picture, because a lot of people have a lot of equity in their homes. The challenge is the people who are purchasing right now, that if we do hit a recession, I think we're going to see interest rates come down. I think we're going to see house prices go up. And so even if somebody a year from now in a recession says, I've lost my job, I can't afford my mortgage payment, I have to sell my house, they likely will have equity because of the fact that there's still not enough homes out there built for the number of people that need them. And so supply and demand says, okay, some percentage of the people who had a job don't have a job anymore, but the rest of the people are still working. That means the people that are still working, there's still supply and demand issues to say, I want a house more than there are houses available to be sold. And so prices will go up as interest rates come down. And just in the last 2 days, the prediction of the Federal Reserve lowering interest rates this year has gone even greater, meaning there's an expectation of more rate reductions this year from the Fed. Just remember, learn this lesson multiple times. The rate drop we're seeing right now is predicting already what the Fed's going to do. So we're not going to see another rate drop when the Fed does it. We're seeing the 10-year Treasury go down. Part of that has to do with the expectation that Fed is going to drop rates. So it's rates drop in anticipation of what the Fed's going to do, not in reaction to. And sometimes if the Fed doesn't do what we expected them to do, rates actually go up when the Fed says they're going down. So we have to strike while the iron is hot, okay? Now, here's what's going on as far as the economy. We had the jobs report today. The jobs report today was actually super strong. With a strong jobs report, that means that the economy is doing well and there's a concern about inflation. So we should have seen interest rates go up today. They didn't. They actually did get a little bit worse in the middle of the day. We saw it pop back up. I showed you guys the chart, but that wasn't because of the jobs report. That was because of really in reaction to the Trump administration saying, hey, we're going to potentially give some relief to Vietnam and the tariffs that we applied there because they're willing to give us concessions we're looking for. That means the markets have seen now an example of Trump being willing to relax. That's the word I was looking for. Willing to relax the tariffs. So now there's hope that maybe the recession isn't coming as quick. Maybe things aren't going to be as bad because maybe this is a play and not a mandate, and that maybe he is going to give in some. But there's going to be countries that are going to be willing to come to the table and make concessions like Vietnam was talking about today. Then there's other countries that are going to say, no way. You kill me, I'll kill you right back. Spies Like Us movie. If you haven't seen it, it's really good. And they're saying, look, you throw a tariff at me, I'm going to throw one back at you. And then you throw one back at me, and I'll throw one back at you. And we're going to get into a war. And so there's two camps that are going to happen. But the truth is Trump has laid down the gauntlet and said, I'm serious, and came out with much, much higher tariffs this week than what anybody expected. And so he's saying, I am dead serious about this, but we're seeing a lot of volatility. So why did rates drop today? Because the market continues, the stock market continues to fall. The stock market continues to not know how to read the tea leaves of what's going to happen. And their biggest fear is recession. And they have not had that expectation of recession as big as they've had, as they're having in the last 2 days. So the number one thing that's happening right now is actually political that is driving interest rates. We still care about jobs, but clearly not very much because today's jobs report did not move the way that it should have, meaning the jobs report was good for jobs, which typically is bad for mortgage rates. We're going to have an inflation report next week. Who knows what we're going to care more about what Trump is doing with tariffs than we're going to care about inflation or jobs. So you've got to be really careful now, because if you're looking to lock an interest rate, if you're looking to refinance your home and you're trying to decide what the right time is to do it, there is so much conflicting news that is going to pull interest rates in lots of different directions. And no longer can we say, well, you know what, hold off until next Friday, because that's when this particular report's coming out. And that's the one that we think is going to move the market. In between now and then, we expect it to be pretty stable. Well, guess what? That's not the case right now. The case right now is we have some news right now. We have other news that comes out in an hour, and that can change things dramatically. I was about to say drastically and dramatically together, which was going to come out to dramatically, but I caught myself. Really, the reality is we're going to see mixed signals, and we're going to see markets respond in weird ways because they're not actually caring about that particular thing, in this case, the jobs report, compared to what they used to care about. So that brings me to my next point, okay? My next point is the vultures are coming out, and they are going to tell you everything that you want to hear about interest rates. And you have to be super careful. First and foremost, I am interviewing for the job of being your lender, so scan this QR code up above. If somebody calls you, emails you, texts you, tells you something that sounds too good to be true, it probably is. Think of mortgages like gas prices. If somebody told you right now, hey, come on down to my gas station, I'm selling gas for $1 a gallon, would you trust them? Would you go? I wouldn't, because gas is not $1 a gallon, bro. Like I can't do that. I won't believe that, because gas is not at $1 a gallon. Somebody calls you right now and says, hey, I got interest rates and they are at 5.5%. Something's wrong. Like something is very, 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 very wrong. So I'm going to give you a couple of resources to look at. And so first of all, let's go here and here and here. And let's go with, where am I trying to go? I am trying to go right here. All right. So one of the things that I will show you, the largest lender in the nation, let's fix this here, hold on. Let's make this guy smaller, move me around a little bit. How about that? Okay, let's do that. All right, so Rocket and Quicken Loans are basically the same company. So if you want validation of kind of where market rates is, largest mortgage company in the nation is Rocket. They have a website here, quickenloans.com/mortgage-rates. You go on there right now, you see a 30-year fixed is at 6.875. 15-year is at 5.99. They're kind of on the higher end of the market, and you got to be really careful about the legal disclosures because they're going to bury down here. Oh yeah, by the way, that 6.875 is at a cost of 2.125. Most lenders are going to be better than where they are at, but this is a good starting point for you to see that when I say better, if they're at 6.875 charging 2 points, maybe somebody's at 6.875 charging 1, or 6.5 charging 2, or some variation thereof. And there's lots of factors that come into play. So could you be at 6.5 with no points, or FHA at a different interest rate, like FHA showing right now 5.99? Although they're 5.99 on FHA, look at the disclaimers, is they're charging 2 points for that. So you got to be careful about what you are seeing here, but that's exactly what's happening in the industry. If you are a homeowner, you need to worry about what you're being told, because not only are they hiding the fees in the disclaimer, they're saying, oh, you're going to get a super low rate. Oh, by the way, you have to pay a bunch of money in fees. That's going to make it not worth it, because you're probably going to refinance again down the road. So you have to worry. Refinancing early in a cycle for a large cost when we think rates are going to drop further is what I'm warning you about. But here's the second thing I'm warning you about, which is that a lot of lenders will flat out lie to you about where the market rate is. Because I can put anything in writing saying, hey, I'm going to give you a 5.5% interest rate at no points. Now, we're the best out there. We're the cheapest out there. It's going to take a while. It'll probably take a month or two to get the loan done. What I'm really doing is I'm waiting and hoping that rates drop. I'm waiting until rates get. It's kind of like me saying, hey, I'm going to give you a gallon of gas. I'm going to sell you gas at $1 a gallon, but you can't actually come and pick it up until I tell you that you can. And so you're like, cool, I'll wait. And now you're waiting and you're waiting and you're waiting. Well, what I'm waiting for is for gas to drop to 75 cents a gallon so that I can sell it to you for $1. If it never drops below $1, then I'll just keep saying, oh, no, there's another delay. So if I promise you an interest rate of 5.5, and I say, hey, sorry, there's another delay. It'll probably be another month or so. This is a really popular program. And then another delay, and then another delay. And it's because they're trying to get you hooked and make you sit in the corner and wait quietly until the market catches what they told you. Then they'll lock you in and close you. It's the biggest scam out there. And you don't know any better because they'll put it in writing, but you got to check, because they'll put it in writing, but the little checkbox that says rate lock, yes or no, it says no. Well, that's normal, sir. We aren't actually locking until the end of the process. But don't worry, that's what our interest rate is right now. They are lying to you. Do not fall for the scam. All right. Next big piece of news, actually, Rocket Mortgage is the root of this, which is the mortgage industry is having significant consolidation, and there's really going to be a tale of two processes of how to buy a home and how to refinance a home. Rocket Mortgage had two major announcements in the last week. Their first major announcement was the fact that they are saying, hey, we're buying Redfin. Yeah, Redfin. Like, Redfin is one of the largest real estate companies out there. They're one of the biggest portals. There's been a lot of arguments over what portal is better, and is it Zillow, or is it Redfin, or is it Homes.com, or they're all spending a bunch of money on Super Bowl ads. Here's the deal: Quicken bought them. Yeah, just Rocket bought them, swallowed them up. Okay, why? Because they're trying to merge real estate and lending together. It's kind of like Amazon and saying, hey, Amazon has become the one-stop shop for everything. But be careful, because it isn't always cheaper on Amazon. It may be more convenient because it's all built in together, but you don't have any local market knowledge. You've got a lender that sits in Topeka, Kansas, or Detroit, Michigan, and doesn't understand your local market, doesn't understand how taxes and insurance work around here. And by the way, I work in a lot of markets outside of California. So I'm saying there is a disadvantage to working with someone that is not local, but you have to compare that to where you're working with someone who's truly knowledgeable in their craft. And these companies that are mega companies, they hire the cheapest labor they can so they can charge the lowest cost. So oftentimes they will give you discounted costs if you use other service providers, but you get what you pay for. And so you have to decide, am I willing to take this risk to save a few dollars on the biggest investment in my entire life, the biggest financial transaction most people will undertake in their entire life? Are you willing to sit back and cross your fingers and hope that you're getting the right advice from the right people who are actually staffing with the least expensive, least qualified people they possibly can? Then they announced a merger with Mr. Cooper. Mr. Cooper is a weird name, so I'm kind of glad that they're merging. Hopefully they get rid of the name. Mr. Cooper is the largest servicer in the nation. They are servicing loans for more people. More people mail their mortgage statement to Mr. Cooper than anybody else that's out there. And now what they're doing is they're capturing all of the people who have their mortgages. 1 in every 6 homeowners will be serviced by the new Rocket Mortgage Mr. Cooper combined company. And their whole goal is to never let you leave their ecosystem. They've got AI about you and understanding everything about your needs and your circumstances, and they're going to try and convince you to stay with them and get in front of marketing to you. There's some advantages to that because they are going to offer you some things that you can't get on the open market, but they're not going to offer you the advice. They're not going to give you the idea of timing or strategy. They are going to be cheaper because they have an economy of scale. But cheaper is this much cheaper, and is it worth it to have the wrong advice? It is no different than when you are buying stocks. You can go on Robinhood, and you can buy your own stocks, or you can hire a person at Charles Schwab, or you can hire a person at a full service brokerage and get good advice. And there's value that comes from hiring the right person to give you the right advice. And it isn't just when you're purchasing a home. It's also when you're refinancing a home. It's when you're taking out equity on the home. And so don't fall for those traps. Couple last things really quickly. The spring housing market, it's here. We are seeing a lot of inventory coming in. We're seeing a lot in different markets across the United States, but in general, seeing more houses come on the market. Market specific, though, we're seeing competition varying. We're seeing some areas where buyers are cautious and they're just really slow to want to get out there. This drop in interest rates, I think, is going to help bring some more buyers in and say, okay, fine, it's ready to pull the trigger. It's also going to cause some buyers to get scared and say, you know what? I'm worried about the economy. I'm worried about my job, and I don't want to buy a home right now knowing that I run the risk of losing my job or my industry changing under my feet. And so it's going to create a lot of turmoil in this spring's market. I feel good about this market. I helped 17 families last month purchase or refinance or pull equity out of their home. One of the best months I've had since really August of last year, September. So great month. Really happy with what I'm seeing in the marketplace. We've got another really strong April setup. Never too busy for you or your referrals, but we're seeing a lot of activity. But that's really not across the board true every market. And so if you're a seller or your buyer, know your market, talk to your realtor, talk to people that are in that market right now, transacting and buying and selling homes to understand what's the temperature of this market, and not just the regional market, like not the geography, but the price point within that geography, because you're going to see different price points move, be more competitive or less. Generally speaking, the lowest priced homes have always been the most competitive. It's interesting what we're going to see, because if you watched my video last week, we talked about lots of changes with FHA and Fannie Mae and Freddie Mac that are impacting immigrant homeowners. And a lot of those immigrant homeowner programs are designed towards first-time home buyer programs, first-time home buyers that are looking to purchase their first home. And those are usually starter homes at the lower price range of the price ladder, of the range of prices. Why am I saying that? Because we're actually taking some demand out of the market for the lower priced homes. What's that going to mean for how competitive do you have to be on the low priced homes? Is this an opportunity to pick up some investment properties on the low prices, the low end of the price range, and rent those out because maybe demand is going to pull back a little bit at the low end of the price market? I don't know, but it's some speculation that you may want to be thinking about, may want to be talking to your realtor about, hey, what do you see in demand? What are your colleagues seeing in demand? All right, I will have time for questions. So the last thing I want to talk about, if you have any questions, feel free to post them into chat right now, and I'll answer them as we wrap up. So look, what's the economic factors that are going to drive rates going forward? I said it before, I'm going to repeat it right now. We're in a time of serious change, serious uncertainty, serious volatility. Generally speaking, bad news for the stock market, good news for mortgages. Generally speaking, Jobs being positive or growing, bad news for mortgages. Jobs going away or recession causing unemployment to go up, good news for mortgage rates. Inflation. Inflation is still the unknown. Is tariffs going to cause inflation? I don't know. If they do, is inflation more important, or is it going to be overcome by the issue of recession? So there's a lot of factors that are competing against each other. And the fact of the matter is, if you like it, lock it. Watch the market, but don't make decisions based on the market, because unlike buying or selling a stock, you can't see the rate and say, I'm ready to lock. You have to have a house in play. If you're refinancing, you have to have your ducks in a row and know what you qualify for. And so you need to start the process early, and I'm encouraging you to start that process with me now. All right, I am done. Let's get into questions, and I have one already. Ricardo says, any Dream for All updates? No movement last week. I was just going to reach out to my contact at Dream for All today, and I've not had time. It's been a busy day. I have no news. I did see last week I got one new buyer that had just gotten a voucher in LA County, so there is some more coming out. And good news, I was wrong about the fact that they were going to shut off the vouchers at the end of March. I didn't say they were going to shut off. I never said that. I was worried that before we hit the end of March, they were going to tell everybody, hey, we're done. We shut off the list. Go home. There's no more tickets for sale. That didn't happen. That's good news. But also, I expected more vouchers to come out this week, because everybody who got a voucher on September 1st, that was the first time that vouchers expired, and some people did not renew. All of those people, if they renewed at the end of December, they were up and they were out of luck at the end of March. And I did not see any movement. I didn't see anybody reaching out to me. You're confirming right now, no movement this week. And so I am worried that Cal Half has kind of turned down the spigot, because I can't imagine there was no vouchers expiring. I know for sure of one buyer who lost a voucher last week, and I really at the end of last week. So that's anecdotal. That's one voucher, but I feel like we're getting close to the end. I've heard no more news. I'm hoping to have some news and to get it to you guys next week. But at this point, that's really all I've got on Dream for All. Guys, if you have any other questions, post them now. If you're watching recorded, post your questions and I'll get to you later. Thank you for listening. Please remember, I do not get paid for being on YouTube. I get paid for doing mortgages. So I'd love the opportunity to guide you as you're looking to buy your primary home, an investment property, a luxury home, refinance to pull cash out, or do a home equity loan or line of credit. I'm your guy. I'm looking forward to taking great care of you and anybody you trust to refer to me. By the way, one more thing, I'm launching a podcast. It is coming out on April 15th. It is focused on business owners and people who are looking to grow their real estate portfolio through investment properties. So it is part of the segment of people I'm talking to right here. But if you know anybody, it's going to be called From Profits to Properties. And my pitch is basically, I'm going to help business owners and entrepreneurs, whether you own a large business or a small one, whether you are a W-2 employee that just has a side gig or looking to grow one. I'm going to help you with tips, tricks, and tactics on how to think like a business person in different ways of things that I've learned as a coach. I've been professionally coached for the last 14 years in business. I've been a professional coach for the last 10 years. And I want to give that information back to you so that you can grow your business and earn more profits, so that you can then take those profits and build long-term wealth through real estate, whether that be buying your first home, whether that be buying a second home or a luxury upgrade property, or whether it's building a portfolio of investment properties that can help you grow over your lifetime. I'm going to help you do that through my podcast, From Profits to Properties. I'm really looking forward to sharing that with you guys, and watch out for it. It's going to hit on April 15th. Everybody, and it's be out every Tuesday after that. Everybody have an absolutely wonderful weekend. Let me know if there's anything I can do, and we'll talk to y'all soon. Bye-bye.